Welcome back to another session of the Q2 Quarterly Roundup. Joining us now is Lara Dalmeyer of Apex Investments. Lara is one of the portfolio managers on the Nedgroup Investments Flexible Income Fund. Welcome, Lara.
Thank you. Thanks for having me.
Straight into it, Lara. Performance has been quite reasonable of the fund. Maybe just give us a breakdown of the performance of the last year.
Sure. If you look at the gross return of the fund over the last year, it's delivered 11.6%. With 3.1% of that being delivered in the last quarter. And what's quite nice to see is we really have had quite a large number of drivers of that return. It hasn't come only from one asset class, it's come from a number of them, some from our offshore component of the fund, but largely from our floating rate component, as there's been a really nice compression in asset swap spreads as well as credit spreads. And also from our nominal bond positioning, predominantly in South African government bonds, where you really have seen a nice compression in yields in both the last quarter and the last year.
So the fund taking full advantage of those multiple levers that you can pull in this fund, right?
For sure. Yeah, we try and diversify the number of drivers of return in the portfolio. Sometimes we call them right, sometimes we call them wrong. But over time, we believe that all these components together will deliver a strong yield for the fund.
I'm keen to get into your views. I think we'll start globally. We've just seen Donald Trump's one big beautiful bill just being passed. This will probably add significantly to the US budget. What are your views on this, and how will this affect the long-term economic growth and fiscal sustainability of the US?
So I think people hear how large this bill is. And I mean, if you look at the chart that we're presenting here, if you look at what it is adding to the US debt, and it's just been passed by the Senate. So if you look at it versus, other acts passed over the last few years, it really dwarfs what we've seen in the recent history in terms of size. So I think people think very large fiscal package has been delivered, big fiscal stimulus, more growth coming out the US. This bill, however, we believe is different. Firstly, it is largely a continuation of tax cuts that were implemented in Trump's first term. So in terms of what the vast majority of this bill is, it's actually not going to really mean a significant change for American citizens. The interesting thing is what's being delivered over and above the extension of these tax cuts. Yes, people are hearing that there is a change, in that you're not going to have tips or, for example, being taxed, and that's good, but this is a small component. The additional components are really increase in security spending, in border security, defense spending, and then to fund what is essentially this continuation of big tax cuts and this additional defense spending, you're getting tax cuts or spending cuts coming in quite significant portions from largely Medicaid and also some food programs. So while I think initially it seems to be like it could be stimulatory, in our view it is at best neutral to the US consumer, but we believe probably more negatively impacts the consumer, just given how large an impact this would have, particularly on the poorer portion of the population. So yeah, we actually have a bit of a contrary view to this bill. We think it is actually potentially marginally negative growth in an economy that is already struggling to sustain these high levels of growth that it has seen over the last few years. Not to say that it's struggling, but it is definitely tempering the rate of growth. Now you're significantly extending your deficit. You're most likely not going to see the offsetting growth. That's not a good combination in our view for the US. We think that growth will continue to slow. Our base case isn't a hard landing recession, But we do think that the growth will lead to quite lackluster levels in an environment where you don't have that much room for more fiscal stimulus, and inflation is going to, in our view, continue to hamper the Fed's ability to stimulate. So we don't have a very positive view on the US.
You mentioned inflation now, and hand in hand with that, I think we can't not talk about tariffs, which has been the other big talking point of this quarter, right? How do you think tariffs, does it just compound the economic pressure that you just spoke about?
Yes, for sure. There will be retaliatory tariffs. The market seems to not really believe the level of tariffs that are being discussed. I wouldn't be too sure. I think when President Trump says something, I think he means it. So I think there will be continued pressure from tariffs. I am not of the view that tariffs are not inflationary. I think there is, a narrative that potentially tariffs are so negative on growth that it's not inflationary. But our view is that on overall, it will have continued inflationary pressure. So, again, as I mentioned, that hampers the Fed's ability to cut interest rates. So, unfortunately, as much pressure as President Trump is putting on Powell, their hands are tied with core inflation still sitting at 2.8%. And we haven't seen the inflationary pressure of tariffs yet. That will only be through Q3, Q4 data. It's hard to act in that environment. So, I've got a bit of sympathy with the Fed.
So a bit of wait and see for them at this point, right?
For sure.
Just maybe staying with the US for a minute. US treasuries, lately they don't seem to be behaving quite like the safe haven asset that they typically behave as.
Yeah.
What do you think is driving this change in behavior? Is it investors? What's behind this change?
Yeah, it's, we've certainly had to kind of reassess our view on US treasuries. The reason for holding a US treasury was, when you had these big global risk-off environments, everything sells off, but your treasuries rally in the market anticipating that the Fed's going to stimulate. Unfortunately now, these big risk-off environments are really being driven because of predominantly trouble with the US. The US is now the problem. It's not the safe haven, it seems to be the problem. So, I think treasuries are telling us two things. One, people are worried about US credit, that when you are moving debt to GDP to 120%, there are concerns around how sustainable that is. I also think that, the way in which global central banks view treasuries have changed. Since Russia invaded Ukraine, those sanctions that were imposed upon Russia were very restrictive and I'm sure it allowed or it led to many central banks reassessing how much of their reserves they want to hold in US treasuries. And you have seen that in the behavior of global central banks. I mean, I've shown you that chart there, and just how much gold central banks globally are purchasing. I think that is now the new safe haven asset, and you can certainly see that in the gold price or Bitcoin price, whichever one you prefer.
Indeed, I think both of them has their fair share of critics, and there's those who love it. So
yes, yeah. Well, I can't comment on Bitcoin, but gold, it certainly has become that safe haven asset that I think, maybe people are questioning whether the US Treasury still holds that title.
Does appear to be a few cracks forming,
for sure,
even if they're just early.
For sure. So in our holdings, for example, we have a little bit of offshore duration, about 0.2 years, but that is really sitting in inflation-linked bonds, where we are still earning a very good real yield, but it does play into our view of that you will have this sustained long-term inflation.
We'll come to the portfolio composition in a minute. I just want to touch on the local economy now. I think, we're talking about bonds and yields and inflation. Of course, the big talking point locally is now with the SARB, right? Inflation locally seems to be controlled. They seem to have room to cut rates. But of course, now you've got them saying they want to lower the inflation target. And this will be supportive of growth and long-term fiscal health. Do you agree with this assessment that the SARB is making now?
So lower inflation targets are better. I don't think that there is anyone who questions that, but I think that it is being oversold. They put out a research paper where, they talked about the benefits in terms of growth, in terms of long-term fiscus, etc. And that paper really was absolute best case scenario. No one should be fooled into thinking that this is a silver bullet that fixes everything. This is a marginal component. We also need to be very aware that you can't just change the inflation target with no cost. There is a cost. In order to move inflation expectations lower, you've got to keep real rates higher for an extended period of time. I think the SARB wants to do this now while inflation is low, thinking that maybe it can mitigate that cost a bit because people have naturally moved their inflation expectations a bit lower. So I can see why they want to do it now. But I think, more broadly, we need to assess, firstly, do we have the capacity for higher real interest rates, just given how sluggish our growth has been for so long? This will hamper growth. And then there is the very real fiscal concern. I disagree with, there's often this talk around how higher inflation targets have higher uncertainty, okay? And when you price bonds, for example, there is this inflation uncertainty premium built in. I disagree with that. I've never met anyone in the local bond market who says that the yield curve is steep because there is a lot of volatility around our inflation target. As a matter of fact, there is only one country, and that's China, that has a lower volatility in their inflation print than we do. So our central bank has been phenomenal in hitting our inflation target quite consistently. I've never met a bond investor who says that our yield curve is steep because they are worried about volatility in our inflation target. Every single bond investor will say yield curve is steep because of fiscal concerns and oversupply. There's just too much duration in the market. So to go and put a new inflation target in place where firstly you're going to hamper growth in the short term, there's a fiscal element. And I mean, if you look in the SARB's paper itself, they talk about baseline debt to GDP projection, and then what happens at a 3% inflation target or a 3% inflation target with a new borrowing strategy that they're proposing to Treasury. But you can see it does lift the debt to GDP profile, and that is in a positive scenario. I think that it is potentially worse than that. So my honest opinion is perhaps we're scratching where it doesn't itch at the moment, and I would rather have preferred a harder line coming from Treasury around fiscal consolidation, which, they have been doing that, I think, a bit more productively of late. But I would say that potentially we first need to sort out some fiscal issues before we entertain this. But you know what? The market likes it, and without a doubt, it's good for bond yields. So it's really just the long-term effects that we will have to wait and see how they play out. But I am probably naturally more a skeptic than a lover.
Hopefully it translates into good bond returns as well.
It will, because your long-term inflation expectations will move lower, so it will lead to a compression in yields. It has already led to even just an expectation of this has led to a significant compression in yields. But there is a risk around the long end of the curve, around what happens when we realize actually growth's not picking up. Debt to GDP is again being rebased higher. Those are later effects that could potentially play out, and we do have concerns around that.
You've just foreshadowed my next question. So how do you see it influencing bond valuations and perhaps by extension, the rand as well?
Yeah. The difficult thing around this talk in the change in the inflation target, and I mean, we say this jokingly, but we're actually being serious when we say we wish they would just tell us what it is, because it's really hard to run bond valuations when there is such high uncertainty around where long-term inflation is sitting, because that is such an important element in your bond valuation model. So we don't know now whether long-term inflation locally will be 4.5% or is it going to be 3%. So if we value a 10-year bond, the way in which we value it is always try and back calculate what the market is implying the country risk premium is. But the market doesn't know whether to use 4.5 or 3. So at 4.5%, the country risk premium is 3.1. That makes me think bonds are a bit expensive. I think the country risk premium should be higher than that. At 3%, however, it's 4.6. That's way too high. Bonds look screamingly cheap. So unfortunately, we're in a bit of no man's land. Now, what I will say is, even if they announce a change in the inflation target immediately, the market won't just move to 3. The market will revise lower, but I think it is unlikely that the market will just naturally, immediately believe that they will hit 3. That will take a bit of a longer time. So if I had to be a bit pragmatic and use kind of the midpoint, I would say perhaps bonds look fairish to marginally expensive at this point in time. Where I do see value, however, is in the short end inflation-linked bonds. Those break-evens have moved very low. So I think there looks to be a bit of value. I do say that with a bit of hesitation, though, because I've thought that for a long time and I've been wrong. So hopefully next time we talk, that would have actually played out. But yeah, I do think that there is the one part in the curve now that there seems to be a bit more value.
Well, this additional uncertainty definitely not making your job any easier, right?
No, it's not. So like we said, change it, don't change it, just tell us what it is.
Given all of this that you just mentioned, maybe let's bring it back together. Like, how are you constructing the portfolio given all of these dynamics and all of these?
Yeah. So if you look at the portfolio positioning, you can see our allocation to the various asset classes in the pie chart. So, with this fund being an income fund, we do construct it so that it is conservative by nature. We construct it so that you can earn your money market plus, 1.5% to 2%, but that you do so with as little risk as possible. So the asset class that we will always prefer will be the floating rate component of the portfolio, where there is naturally no duration risk and where we manage the credit risk as conservatively as we can. What do I mean by that? We do not take exposure into unguaranteed SOE debt. We do not buy AT1 debt. We essentially just invest in credit with an effective rating of A or better, and where it is listed. We also don't venture into the unlisted credit space. So that really is a very nice, conservative, strong yield underpin for the portfolio. And then over and above that, we'll take certain views in certain sectors. So we will look to take a certain amount of nominal duration. The portfolio at the moment has 0.7 years, and that is translated by the 21.1% fixed rate bond component. That's predominantly South African government bonds. Given that we view bonds fair to maybe slightly expensive, we've held onto our duration a bit longer than what we normally would, given the fact that there is a bit of uncertainty in this inflation target, and in our view, it is likely that it will change. So we've held on to our duration a bit longer. We haven't increased duration in anticipation of this, but what we have done is move our term from the shorter end belly of the curve into the slightly longer end of the curve, where should this all transpire, we believe you'll see a further flattening. Okay. And then we have about 0.3 years inflation-linked bonds. That's about 11.4% of the portfolio. And that really is all in those short-end linkers where I mentioned we like the break-evens. And then we've got 2.3% in pref shares, decreasing naturally as banks buy those back. And then we've got about 12% offshore. As I mentioned, we predominantly in longer end tips, so that translates into about 0.2 years offshore duration. But over and above that, we really are just investing into high quality credit, giving a nice, yield pickup. Even when translated back into ZAR, you would naturally pick up that interest rate difference because we do hedge the vast majority of that exposure back into rands. You are only exposed to about 2.2% of hard currency exposure. So 10% of that 12% has hedges on top of it. And then lastly, we've got about 1.7% in SA property. It has run very hard, so we have trimmed back. I think, if we had to kind of compare local property valuations to bond valuations, given that they're both duration assets, we marginally have a preference for bonds. So we are keeping that sector underweight for now.
That 9.1% yield looking, of course, very attractive.
Yes, I should probably mention that's very important. The yield of the fund is 9.1% at this point in time. Listen, we think, given the, let's say, quite uncertain global backdrop at the moment, and the conservative nature of this portfolio with such a strong yield, we think it's a very nice place for investors to be at this point in time.
I certainly enjoyed that conversation, Lara.
Thank you.
I think, despite the uncertainty, we know the portfolio is in good hands with you and Philip and the team at ABAX.
Thank
so we
you.
appreciate your insights and your time today.
Thank
We'll
you.
leave it at that. Thank you so much.
Thanks for having me. Thanks.
Thank you.
Bye.